Hey there. So in this video, we're going to go over very in-depth the risk parameters of our algorithm and our system. So I know we have the video of the algorithm in live action, and then we also have a video where we go into the FX books and looking at the ROI, risk of ruin, drawdown, and those bits of information are definitely very, very important for you to understand a trading system, how it works, what are the risks, what's the upside, what's the ROI like. Um, but this video specifically actually has information that the live algorithm in action video and the FX books and ROI and risk of ruin and drawdown videos does not have. So this video is going to go over what real life scenarios will we need to encounter with our risk settings to actually see a loss or to get stopped out or hit an equity stop or stop loss, right? Emergency exit button, essentially. So I've actually taking the last 10 years, 2015 to 2025, and I asked ChatGPT to scour the internet and find me every single scenario, right, for the forex, both the forex major and minor forex pairs. In those scenarios, with all of the instruments that we trade, I asked ChatGPT to scour the internet, and then I cross-referenced and I checked this all myself. So it was actually missing two. So I had it find those two extra dates, and I had him add in all six of these scenarios where there was more than 500 pips moved in a single day, right? So those are normally going to be the scenarios that can theoretically stop us out or cause a loss. Now, very first thing I want to tell you is, which rather you've come from the previous videos and whoever you're speaking to about the Gemeos copy trading service, whoever you're speaking to about the system is you have access to the live action algorithm video and as well as the FX books video. So I go in depth on the FX books. So if you have not seen those videos, it's going to be important that you watch those ones as well. So again, if you haven't seen those, you're definitely going to want to ask to see those. Okay. But in this video, like I said, I'm going to go over what reality, what actual things that happen in real life that will cause us to actually take a loss. So in the last 10 years, there's been six events where the markets, no matter USD Canadian dollar, GBP USD, USD JPY, out of all the major and minor Forex currency pairs, where did we have over 500 pips moved in a single day, which is this? And the reason I asked it this question is because that's the likely scenario that's going to stop us out, right? So we're getting right down to the nitty gritty. And obviously the more attractive thing is the ROI because our ROI is very high, but you have to know and understand the risks, right? So nothing in life is guaranteed. If you're looking to do more than 5 or 10% a year outside of a mutual fund, you're looking at starting a business or doing some other types of investing. So with day trading, there's ups and downs, and you have to be okay with the ups and downs that is day trading. But in the down scenario during drawdown and potential stop out risk, I want to paint a very clear picture for you. So we have in 2016, the biggest one was GBP USD went 1,770 pips in a single day. So ignore this right here, though. Ignore the stop out because it did it wrong. And then, like I said, I looked over every single thing that we're looking at here to double check and cross check everything's accurate. So ignore these because these are wrong. But the dates and the pair itself obviously correct because it pulled it directly from the internet. And I cross checked all this information, like I said. So the reason that GBP USD lost or moved 1,700 pips in a single day is the UK was deciding to pull out of the European Union. So if we go up here a bit, these are the reasons why they happened, right? 1,700 pips in one day, June 23rd, 2016. Why did it happen? UK voted to leave the EU, caused a historic GBP collapse. And then December, and then we have the next one, 2019, we had GBP NZD, New Zealand dollar, UK election, exit polls, blah, blah, blah. That's why that happened. Then we have some 2022 scenarios, 500 pips in one day, mini budget crisis. 513 pips in a day, largest drop on USD since 2016, driven by a lower US CPI data and a massive yen strength. Now, there was one other USD JPY move that this missed, but it's less than 500 pips. It was like 400 pips something. That's why it's not here. And then 2023 August, we have GBP fell sharply. And then December 2022 was a 700 pip move for GBP JPY. So these are the six scenarios where the markets have moved more than 500 pips on the instruments we trade in the last 10 years. 6 times in 10 years where increased risk has occurred, essentially, right? So now, like I said, ignore the parts on the chart because I had to do math over again because I had to ask a bunch of new questions for it to understand our system and for it to also give us a better idea, a better breakdown and a more accurate breakdown. So I had to tell ChatGPT that we do 0.01 lot size for every $4,000 on the low risk setting. So here's your low risk setting. Number one, $4,000 account. Now, it trades proportionately. So if you have 40,000 or 20,000 or 65,000, it's going to be a 0.01 lot size for every $4,000. That's the trade that it's going to open. And normally we will open up upwards of 15 positions on a single instrument at a maximum. That would be our max equity exposure on a single position. And we normally do not have max equity opened on more than one instrument in a trade session. Though we can trade more than one instrument during a single trade session, we normally don't have max equity exposure on more than one position. And also the max equity exposure doesn't happen often either, but it does happen and it can happen. So I said, let's go with the worst case scenario, obviously, right? We're going to give max equity exposure. We're going to have 15 open positions on one trade. And I even did not include the fact that the difference between the positions would be pips apart, like 5, 10, 20 pips apart, right? I'm just putting at all of these positions are opened at the same price. So let's just say we opened up a position on GBP USD, right? The big move, 1,700 pips, June 2016. And we opened up 15 trades, so our maximum equity exposure on this position, and we opened them all at the same price. So instead of having our portion lot system, which gets us a better price and helps decrease drawdown, I'm removing that factor from this scenario so we can be even more conservative and even more more risk than what we actually take. So this is to give you a very in-depth look, and I even removed one of the variables so you could see it in a more raw form. Now we have 15 positions open, okay? And 30% stop loss or 30% stop out of 4K is $1,200. This to you does not matter. This is just how the system works. 0.01 lot size for every 4,000. For you, let's say you had $40,000, right? That means it's going to be 0.1 instead of 0.01. The percentage does not change, but the monetary values will. The monetary values in this case does not matter because the stop loss is set to 30%, not $1,200, right? So no matter how much money you have in your account, 30% is going to be the stop out. Doesn't matter the monetary value, right? So now that we have that clear, and we have 15 positions open, right? And in this scenario where GBP USD lost 1,700 pips, would this have stopped us out? Based on our maximum exposure in this scenario, and if you see right here, it would have actually been 2,600. So that's over 50%. So our 30% stop loss would have been hit. Yes, you would have been stopped out during this move. If you had a trade open on this position, which again, we don't always, we aren't going to just trade every single thing every day all the time, right? But if we did have a position open on this, and if it was maximum equity exposure, then we would have been stopped out. Now, and this is one time in 10 years where we had that big of a move in a single day. Then we have down here 700 pips in a single day. 700 pips would have been 1,050 or about 25-ish%. So no, we would not have been stopped out during this 700 pip move. So this is basically just giving you how many pips have to move against us and how much exposure do we need to have to actually hit a stop loss. So if we're at maximum exposure, then obviously 1,700 pips is going to take out anybody. And this is the reason we have stop loss in place for events that we cannot predict, right? And again, there's other things that we can predict. We can get out of the market. Sometimes we can close manually. We can intervene manually. We can also just not trade for the day. We can turn the algorithm off ahead of time. The other thing is we do not have a crystal ball, so sometimes hindsight's 20/20. So events like this are not always something that you can predict and or avoid. So you have to understand that as well. Nothing is perfect. No system is perfect. And if there was a perfect system that was able to avoid drawdown all the time, everybody would be a billionaire by now as a day trader, right? So you have to understand that. That's why we're going through this video and for you to understand the actual risks. And as you can see so far, if you're already kind of catching an idea, the risk is going to be very low because if you just go down here, so even the 700 pip move would not have stopped us out. So obviously anything below 700, if 700 didn't take us out, why would any of these 500 ones, right? Not going to take us out, not going to take us out, not going to take us out, not going to take us out. So not going to make us lose 30%, I should say. But over 1,700 pips would. Now, I did the math, and based on our system and having maximum exposure, sometimes we could have a handful of additional positions open on other currency pairs. So, and in those scenarios, we could have upwards of I would say a 30% added equity exposure or a 30% less equity exposure just based on other positions on other currency pairs at the same time. So if we happen to have this maximum exposure open on this position, but then we have another position open that's profitable, upwards of a 30% buffer. So let's add 30%, that 30% buffer onto both sides of these scenarios. So obviously, if we had added 30% here, we already know we're getting stopped out here, right? So adding 30% doesn't change anything. We're going to lose 30% in a scenario like this. But a 30% decrease, you could essentially just look at this being down 50%, right? So if we took away 30% buffer here, if we weren't, maybe we only had half the exposure, right? Not 15 positions, we had 7. Not 15 positions, we had 3, 12, 8. Also, 0 positions means no stop out. If we had half the exposure, something this big would still stop us out. If we had a 30% buffer, right, adding 30% onto here, we would have been stopped out. If we had 30% less, well, what would that be? 2, 4, 6, about $700 less. We still would get stopped out on a scenario like this, even if we had slightly upwards of 30% less equity exposure, based on having other trades open that are opposing and in profit and or added exposure through other positions. We would still be stopped out with that 30% buffer. A 30% buffer on 700 pips would bring us down to, well, we didn't get stopped out at 700 pips here. So obviously a 30% better positioning, right? So like 580 pips, we're not losing money, right? But 800 and 900 pips, right? 30% buffer on that would have added 30% onto here. So $1,300-ish, which is more. So we technically would get stopped out. We could get stopped out on a 700 pip move if we had other positions open that had us in a drawdown of an extra $200, right? So like I said, adding a 30% buffer to be extra realistic and extra safe, and also for you to get a better picture painted for you. So I would say any positions above 650 or 600 pips pose a risk for us to be stopped out. So knowing, and that's on the low risk system. So knowing that moves of above 600 pips, if multiple variables, this is the other thing you have to keep in mind, which are really hard to account for because they can be of anything. Like it's so many different variables. We could have less positions open. We could have other positions open on different currency pairs that are in a positive or in a negative. That's why we've added the 30% buffer. So that buffer on both sides helps us account for those variables. So if we had a 580 pip position open, right? If we had 30% positive, but then we still had a 700 pip drawdown on one position, but we were 30% positive elsewhere, we would not have got stopped out, right? But if we had 30% or another 100 and 200 more pips, if we had 200 more pips negative on a different currency, that would have brought us to $1,300. So yeah, technically a 700 pip move here and a 200 pip move on another one definitely could have us hit a stop loss. But if we do a 30% buffer on anything at 500 pips or lower, well, 500 pips, a 30% buffer brings us to 650 pips, or it brings us to about $1,000 drawdown. And our threshold is 1,200 or 30%. So anything around 500 pips, even in a worst case scenario where we have maximum equity exposure, we have other positions that are in a $200 dollar drawdown or another 10% in drawdown, this is not going to stop us out on the low risk system. That means it's very, very, very safe because most people's systems will get stopped out at 100 pips, 150, 200 pips. We're not even entering 10% drawdown at 100 pips, right? Not even close. So this just goes to show you how safe the low risk system is. Now, if we could just break it down to a simple explanation, this is how many pips it would take for us to theoretically or potentially hit a stop loss. And the likelihood of that happening, well, in 4 years, we've only ever had it happen 1 or 2 times on the old system. So as of April 14th, the algorithm got a huge upgrade. And the old system technically could get stopped out at about 350, 400 pips. We now have a significant decrease in risk. So now it's going to take, like I said, 700, 800, 900 pips to stop us out on the low risk system. But it could stop us out at 600-ish if we had other opposing positions open that also went into the negative at the exact same time. Again, variable. But again, we're accounting for that variable how? By adding a 30% buffer. So in totality, we know it's going to take anywhere from 580 pips or above to stop us out on the low risk system, depending on other equity exposures, other positions we may have opened, and the like. So with that being said, how often does moves of 580 pips or greater happen? And in 10 years, we have 2. 1, 2. 10 years, we have 2 times where we had more than 580 pips. And even in that scenario, so that's 2, in 10 years, you have a 20% chance of hitting the stop. Or in 10 years, you might hit it twice. So in 4 years, we've hit it once or twice, right? So we had a 12.7% loss May 2022. That loss we cut early because there was a very good chance we were going to hit a 25 or a 30% loss. So luckily we got out early, and then the recovery window on 12% is very small. Recovery window on 30% when we do 6 or 7 or 8% a month is also only a few months. So even if we do have these scenarios in a 12-month calendar window, including a losing month like that, we're still going to yield a profitable year or an annual term, even if we do hit a hard stop on the low risk system. Right? So this is what it's really going to be like. So what are the chances, if I could boil it down to a ballpark percentage of how many times are we likely to hit a hard stop based on what we're looking at here? Now you can do your own math, but based on what we're looking at here, in 10 years, we only had 2 times where we had more than 580 pips in a single day. And then if we have that 30% buffer, we're looking at 2 times in 10 years. I guess that's once per year, once every 5 years. So in 5 years, you have a 20% chance of hitting it 1 time. In 10 years, you have, well, it's 2 times in 10 years. So you still have a 20% chance of hitting a hard stop in a decade. So in a 3-year window, you're looking at like 5 or 6% chance of going 3 years and not hitting a hard stop. And that includes a buffer, but that does not include the other variables that I removed, like us intervening and getting us out early, and then also having other positions open that are in profit. And then so cutting early or getting out early in profit or intervening manually are other things that we can do to make sure that these actually don't stop us out. Now, these are just theoretical scenarios, but it is very solid information because this many pips is how much it would take to potentially stop us out. So if I could boil it down to a simple answer, it would be in 5 years, you have a 20% chance of getting stopped out 1 time, right? 30% loss. And now in 5 years, right, if you're with the system for 5 years and you do get stopped out 1 time for 30% at some point, just keep in mind that over 4 years, from April 2021 to April 2025, we did over 3,000% in gains, including those losing windows. Over 3,000% in compounded gains in 4 years, even with losing periods. So even if we have over the next 4 years from making this video where our system is now, even if we have a 30% loss over the next 4 years 1 time, we're still looking at having insane gains, right? Like that small loss will not destroy the investment. It will not create such a large deficit we can't get out of it. That's why we have hard stops in place. Because if we didn't have them and then you just lose 100%, yeah, good luck getting 100% back. There's nothing for you to gain on anymore, right? And so that's kind of to help paint a picture for you. Now on the high risk system, it is a 48% hard stop and stop out level 48%, 0.01 lots for every $2,000. So if we had these same scenarios, how many pips would it take to stop out the high risk, moderate, high risk system versus the low risk? So as you know, the low risk, it's going to be 580 pips or more. Like sometimes a 700 pip move might not take us out if we have if it's just 700 pips on one position and there's no other positions open, it's not even going to stop us out on the low risk system. We need to have other positions open, right, that are also in the negative. If we had positions open that are in the positive, this is definitely not going to stop us out. It's going to take 900, 1,000 pips to do that to us, right? That's why it's called low risk. This low risk system really is of low risk, very low risk. Now the moderate high risk, we're looking at 0.01 lots for every $2,000, right? But it has a 48% stop out. So we have the extra breathing room for us to potentially not get stopped out, right? So 1,700 pip, we know that's stopping us out on the low risk, so obviously it's going to stop us out on the high risk one. 700 pip move is also going to stop us out on the low risk with a 30% buffer. That would bring it down to $700. With a 30% buffer, we would actually potentially not get stopped out with 700 pips on the moderate high risk system, depending on the scenario and the variables, right? Other positions open, etc. Or if we don't have full exposure. So if we don't have 15 positions open and we only had 5, like less than half, a third, we're definitely not getting stopped out there, right? But 580 pips or above in a worst case scenario will stop us or could stop us out on the low risk. Now, 450 pips? Let's see. 500 pip moves do not stop us out on the high risk system, even if we have that 30% buffer for worst case scenario. So adding 30% adding 30% onto this is another 200. So technically that would be right around the stop out actually. So we could potentially be stopped out around 500 pips in a worst case scenario with maximum equity exposure and an added 30% deficit or drawdown from other positions, right? So the likelihood of that happening obviously decreases because then you have to add in those variables. The more variables you add in, like a parlay with betting, the more players you want to make 20 points per more per game, the less likely of it happening. Decrease the odds. But obviously, we still want to look at those scenarios. Now, in terms of just the general consensus of what's going to stop us out or could stop us out on the moderate high risk system, let's do a 30%. 30% above this is going to be 650 pips, is normally going to potentially stop us out. But again, not always. It depends on our exposure and other positions open. Again, you got to keep those variables in mind. And again, those variables are basically a 30% buffer. So 30% on the high side, 500 pips, add 30%, we're looking at 650, and that would be right around stopping us out. 30% less than this, so we could have a 500 pip negative, and we could be in not getting stopped out, but then we could have 30% buffer for positive positions open that same day. That bring our drawdown down to like $600 instead of $750, right? The opposing buffer on the bright side. Or not having maximum exposure. Let's say we had 10 positions open and no other positions. We're definitely not getting stopped out by 500 pips, not even 600 pips. So this is to give you an idea. Now, how many times does 500 pips or greater happen in a decade? Well, once 6 times in 10 years, right? 500 pips or greater in the same day, not including any variables. So realistically, we had about a 20% chance in 5 years or 10 years of hitting a stop out on the low risk system, right? That is not going to affect overall ROI. Overall ROI is still going to be insanely significant. Now, on the moderate to high risk system, if we do get stopped out 48%, but we do 10 to 20% a month ROI, or an average of 14% a month on the high risk system annualized, and we lose 48%, we're looking at having like a 6 to 7 month recovery window and still ending a 12-month period profitably, even on the moderate to high risk system in a bad year where we do hit a hard stop. Now, 600 to 650 pips or greater could be a scenario that stops us out, not on the low risk, but on the high risk. It's more possible. And now if we have those moves, which happen 500 pips or greater is almost once every 2 years, you have a 50% chance, not including variables, of it happening once in 2 years, right? Now, if you add in the variables and a 30% buffer and the ability to get out early and having opposing positions open, you're looking at like a 25 to 30% chance of it happening in a couple year window. And will that defeat the purpose of the ROI over 2 years, 3 years, 5 years? No. Right? So moderate risk, getting stopped out 50% one time every 2 years, but it does 150 to 200%, not including compounding every year. You're looking at eliminating 30% of your gains. So in 2 years, if we make 500% or 400% including compounding, but we lose 50% partway through, instead of doing 400 or 500%, maybe we do 200 to 300% in compounded gains in a 2 year window. And that's if we hit a stop out. Now, if we don't hit it at all, obviously the gains are going to be a lot higher. But this is to kind of give you an in-depth look at what is it really going to take for us to hit a hard stop? What's it really going to take for us to hit a stop loss? If you don't like the fact that there's a 20 to 30% chance of hitting a hard stop every couple years or every few years with the moderate to high risk system, you do not have to use it. You can go back to the low risk system, which only has a 20% chance of hitting a hard stop of only 30% once every 10 years, right? Once or twice every decade. And that doesn't include the variables of us being able to get out early and having like half the exposure kind of thing. So you have to keep that in mind. The low risk system is designed to be very profitable, both short and long term. The moderate risk one obviously carries more risk naturally. So if you're willing to take that extra risk, you're obviously going to get more reward, but then you're also increasing the chances of getting stopped out. And if you do, you just have a longer recovery window. But the good thing is, based on probability, if you ever do get a hard stop out of the way, you now, based on probability, are going to be going a nice, really long time where you're not going to hit it again, right? So, and as we improve and we get better over time, we're not only increasing and improving the algorithm, we're also improving as traders. And because we can manually intervene, anytime we have scenarios like this that we're going to be able to predict, again, nobody has a crystal ball, but when we can predict things like this, which we've done multiple times, by the way, we don't lose money. Like, so take a look at it. If you go look at the FX books, we got 2022s in here. We got 2019, 2020. We got 2022, 2022, 2022, 2023. We didn't lose money any of these times, right? We did not get stopped out during these windows, not on moderate risk, not on low risk. So that should give you an indication. Okay, so if it's a 20 to 30% chance of getting stopped out once every couple of years with the high risk and once every 5 years with the low risk, based on it happening 6 times in 10 years, right? Well, if we only get stopped out one of these 6 times, or 1 or 2 out of 6, that decreases the likelihood significantly by adding in those variables. So now we're looking at like a 5 to 10% chance of getting stopped out once every couple of years on the high risk, and like a 5 to 10% chance getting stopped out on the low risk once every 5 years or twice every 10 years. So those are the variables. If you add those variables in, the risk gets decreased significantly. Again, none of these 2021, 22, or 23 instances stopped us out. And you can see it on the FX books. None of these actually stopped us out. So we were obviously able to, 1, avoid these naturally, luckily, or 2, intentionally miss these periods, right? One of the two. And either way, those variables help us decrease our likelihood of actually getting stopped out. Now, there's also a potential, depending when you're watching this video, we are considering introducing a third option, extra low risk system that trades 0.01 lots for every 6 to 8,000 instead of every 4, which is our current low risk system. It would still have around a 30% stop out. But doing that would decrease the ROI, right? So this system does around 6 or 7% a month, averaged, annualized. If we decrease that by 50 to 100%, so per 6K to 8K, we'd be looking at about a 3 to 4% monthly ROI. But then we'd be looking at like a 2 or 3% chance of being stopped out once every 5 years or so. And being able to do 30 or 40% a year, not including compounding, and having less than a 5% chance of getting stopped out once every 5 years, and that's only at about a 30%, is insanely low, right? So I hope this video helps you. I hope it paints a very, very clear picture of how low risk our system really is. Even on the moderate risk settings, the risk and the chances of you hitting hard stops are less than 25% over a period of a few years, and that doesn't include the variables. But I also want you to understand that the likelihood and chances do still exist, and I hope this video helps you kind of understand those when it comes to making your decision to use our system.